given all of the nervousness on some fronts about the debt, it's surprising, at least to me, the equity markets didn't really react all that much, did they?
They didn't. I would say the market's generally been reacting by rotating as opposed to pulling money out. And if you talk to U.S.-based equity investors, they'll tell you, hey, look, we've seen this story before. The stakes are high, but we think a deal is going to get done. So they've moved out of cyclicals and into things like tech and defensives, which is generally what you see in debt ceiling drawdowns. But at the same time, we're hearing from the big kind of non-U.S. investors that they've been very worried about this. They don't know our politics as well. So I would say kind of the steadier hands, the more kind of even-keeled local investors are taking it in stride. That doesn't mean they don't care. That doesn't mean the markets won't react if we don't end up getting a deal. But there is a patience here that makes sense.
Gillian, as we talk right now, they're still going back and forth, promising there's going to be a deal, there's going to be a deal. There isn't one as of right now. But let's assume, in fact, they do get a deal done the way both sides say they will do. Will there be a collective sigh of relief? Will that really put some wind in the sails of the markets?
I think there certainly will be a collective sigh of relief. You've already had another of the rating agencies indicated in putting the US on negative watch in terms of the treasuries market. And we've had S&P downgrade the US back in 2011. If a second rating agency downgrades the US as well, then that would really change the way that the world looks at that US treasuries. So obviously, if that can be avoided, that would be a huge source of relief. However, the questions that investors are going to be asking is, how long is any deal going to last for? Is it just a sticking plaster solution for a few months? And then secondly, what kind of fiscal outlook does the US now have? Can they actually create that long-awaited bipartisan commission to get serious about trying to talk about both revenue and spending cuts in the future?
Yeah, that's the question we keep asking. We don't get an answer to, unfortunately, Gillian. Exactly. Lori, the S&P is on something of a run right now. This year so far has been pretty strong. There have been those who said, you know, that's wrong, that we should go bearish. We have a 4,000 estimate, basically median for our elves. You are one of our elves. You're a little higher than that, 4,100. But you're still below where we are right now. So do you expect the S&P 500 to come down by the end of the year?
So we've said it can be choppy through the end of the year. The debt ceiling has been something that we've been worried about as a potential downside catalyst. So if we pull that off the table, that definitely does brighten the outlook. You know, look, and we're at 4,100, and that's in part because we think valuations are about where they deserve to be. But I would say, you know, one of my constant conversations with investors over the past few weeks has been, this is not a stupid rally. I mean, this is, you know, something that has made a lot of sense. A lot of people are pointing at the tech trade saying it's not deserved. It's been one catalyst after another that makes sense, that's pushed people into those stocks, and the math has pushed the market up.
And what about earnings? You actually have a chart indicating that we actually are bouncing back a bit on the earnings projection.
I think this is one of the most underappreciated things going on in the market right now. If you look at the rate of upward revisions in the S&P 500, so just the percent of estimate revisions that are happening, changes that are being made to forecasts that are up as a percent of total, it hit 51% recently. That's important because it means we're technically back in upward revision territory, and 8 of 11 sectors are seeing improving revision trends, and 4 out of 11 themselves are in positive territory right now.
So, Gillian, this is all fine and good, but as Lori sort of adverted to, it's a fairly narrow rally, actually. It's just a relatively few stocks really driving it. Gillian, should we be worried about that? Does that indicate something about the strength of the equity markets right now?
It is a fairly narrow rally. I think the bigger question hanging over the American economy right now is, how come there hasn't been a recession yet? Because I was down in Richmond in Virginia talking to a number of Federal Reserve officials down there about what's happening in the grassroots of the economy in the American South. And the unanimous message from people who are going out and about and interviewing businesses is that actually, although they've been expecting a recession, there really isn't much sign of a significant recession yet. And more importantly, there isn't much sign that price pressures are really sinking back to the Fed's target anytime soon. So in many ways, I suspect what's going on in the market is a bit of a relief rally, that there isn't a recession yet. As you've heard, the earnings are coming in slightly better than expected. But the really big question people are going to be looking forward to, if, and let's say if, the debt ceiling drama gets sorted out in the next day or two, is, you know, what is going to happen with the Fed and inflation going forward.
So Lori, what about that recession question? Because we have been hearing these projections of a recession in 2023. It was going to be the second quarter, it was going to be the third quarter, now it's going to be the fourth quarter. Is it just a matter of timing, or is there a question even of whether there will be a recession?
I think there's a question, a legitimate one, about whether or not we're even going to get it, or if you end up getting something similar to 2015, 2016, which was pretty close, but not quite. And I think what's interesting, and I see this more from the lens of earnings, is that we're in an asynchronous cycle in terms of the economy. There are different industries and different sectors that are going through different processes at different points in time. If you think about sort of your inflation, sort of beneficiaries, the beneficiaries of higher interest rates, things like financials and energy, they saw big upward revisions last year, while tech companies, growth companies, supply chain-centric sectors were all seeing downward revisions. Now the tables have turned. Everything that was getting hurt last year is in a recovery, and things that were benefiting from inflation and interest rates ramping are seeing their downward revision cycle. That's a very, very confusing cross-current, but if you spread the pain out a bit, you could actually skate by without a true sort of recession happening.
One more before we turn to everybody's favorite topic, which is, of course, artificial intelligence. But Gillian, to you, you mentioned the Fed and what the Fed's likely to do. We got some strong numbers in this week, actually indicating both on the inflation staying up, but also the economy being quite strong. Where do you think the Fed is heading? Do you think they're going to continue to rise at all? And by the way, if you want to, you can give us the jobs number for next Friday. It's okay.
Well, if I did that, I'd be a trader. I think the Fed is under pressure to keep raising, keep tightening. It may skip that for this coming meeting and do a wait and see stance, but I certainly don't think it's going to cut anytime soon. And I think the market projections of 25 basis point rise now is quite reasonable, given the fact that we still haven't seen a significant decline in the inflation rate and the economy hasn't yet shown signs of being in recession. I think in many ways the more interesting issue that the Fed's also facing, though, is it going to give any hint of rethinking the inflation target going forward? Again, one of the messages that came back from being down in the South earlier this week and talking to people is that a lot of the commercial real estate sector are constantly asking Fed officials, are you going to change the inflation target? There's a kind of desperate hope amongst many in that sector that actually the rate rises will stop because the inflation target changes. Now, the Fed's been very keen to squash that quite forcefully. But that question is going to linger and linger, particularly if the inflation keeps coming in higher than people had expected.